Wealth advisory company Citadel has recently created a family office to cater to the needs of the ultra-wealthy clients with 50 million rand or more to invest. With the economic recovery around the world faltering, Citadel has been advising clients where to invest their funds across asset classes. Earlier on, Warren Dick spoke to David Mohr, Chief Investment Strategist at Citadel, to give us his views on these issues. Take a look.
We're here with Dave Mohr at the Park Hyatt in Rosebank, and Dave is the Chief Investment Strategist of Citadel. Great to have you on the show, Dave.
Okay.
You've given an extensive presentation today on the state of not only the South African economy but the world economy as a whole. So let's, I think, start there and just take us through the title, which says "Recovery Almost 4 Years Old. What does the future hold?"
What we did was, Warren, we had a look at what has powered the economic recovery up to now. And looked at those factors and looked at the prospects for those factors, and then from that we tried to derive what is the outlook for the economy as a whole.
Now, very broadly, I think probably a good starting point is South Africa and the state of the South African economy. We've seen the IMF revising the forecast down for next year. Just take us through the different elements within the moving parts, so to speak, and what you think about what South Africa is going to deliver as an economy in terms of GDP.
If you look at it, first of all, I mean, our economic cycle is very closely linked to the global cycle. In fact, in terms of the trend and in terms of the level of growth as well, it's uncanny almost. So if we look at the global economy, we know that there was a synchronized downswing last year. There were some indications beginning of this year that things were starting to improve slowly, and we're hopeful that will continue. But what is not on the cards, it doesn't look like it's going to be a very strong economic recovery globally. Essentially, there's still a lot of fiscal headwinds, and as we saw recently, even in China as well, they seem to have settled into a 7 to 8% growth range. So the impact of that we think is likely to be positive, but more importantly as well, commodity prices and our key commodity prices have been weak of late, and we need to see some turnaround. Otherwise, the net impact of the international side is not going to be a net boost for the local economy over the next 18 to 24 months. The other factors that we've looked at is that fiscal policy has played a very strong role in generating growth in South Africa. We've had a very strong increase in government spending, particularly in terms of the wage bill. But we've now reached a point where if you look at the budget deficit, there's no more scope to stimulate the economy from a fiscal side to the extent that we've done over the last 3.5 years. So on the fiscal side, we're increasingly going to see a move towards austerity. In this budget, the minister already cut the projected spending of the budget for the next 3 years. We might even see in the next budget some actual cutting of the existing spending. And we know that they're going to look at the tax base as well. And I think they're worried that they're not getting the income from the tax base that they should. So we think the combination of fiscal policy is not going to be positive looking at the next 18 to 24 months as well. Sorry, and with that also the infrastructure program has really not added that much to economic growth of late, and there doesn't look to be a lot of fiscal scope for that to stimulate the economy either.
We saw Pravin Gordhan give the budget speech this year. It was very much a budget speech that looked like it was gearing up for an election. He sort of delayed all the painful cuts. Do you think he's going to have the resolve to cut expenses and really control government costs going forward if he doesn't get the increase in the revenues?
Well, that's going to be the million-dollar question, because if you think of it, we're closer to the election next year with the budget as well. So from that point of view, I think he's getting painted into a corner with his deficit that seems to refuse to fall anything below 5% of GDP. And the kind of growth that we're looking for the local economy for this year and flowing into over next year is not much higher, if anything, than this year. We think there's even a chance growth might be slightly lower this year. So I don't think that revenue growth is going to surprise him on the upside. So they will have to make some very difficult spending decisions.
Very tough thing to do if we look at what's happened in Europe, and that's maybe where we can go next with this is what's your sort of sense of what's taking place in Europe at this point?
Europe is in an economic recession. What we've seen is obviously the southern part of Europe in a very severe recession. The core, particularly Germany, that is basically stagnated as well. So I think from that point of view, we don't expect a lot. We expect them to remain in an economic recession.
America's looking quite promising from the housing recovery point of view. What do you think about the prospects, for that economy, and specifically what the markets, the US market seemed to be the bellwether for the rest of the world. A better year than last year?
We think pretty much the same. We think the private sector's outlook's more positive. If you look at it, a lot of deleveraging has happened for individuals. Their financial situation has improved. Companies are in fine shape, highly profitable, sitting on lots of cash, so we think that's fine. The labour market looks like it's improving. So from the private sector side, they should show some faster growth. Their problem is the fiscal headwinds. They've avoided the full fiscal cliff, but they've still tightened fiscal policy significantly. So we expect more or less the same growth rate for the US for this year than we had last year.
So does this still leave the role of the Federal Reserve, in the case of America's central bank, as the sort of preeminent force trying to shape that recovery? Because, as you say, there's limited scope for them to apply any more fiscal easing. Are we going to see, how long are we going to see these interest rates as low as they are for?
Well, it certainly looks like, if you look at their ambitions where they want to see the unemployment rate, it's going to be for at least for another 18 months. That interest rates are unlikely to increase. But as I said, I think the main driver would be a private sector that has healed financially over the last 3-4 years that will drive US growth.
We've got quite a comprehensive picture around what you think about the different roles and states of the economies at the moment. Your job as an investment strategist is to translate that into what that means for investors from an asset class perspective and across markets. So let's just do that. I mean, fixed income has almost become a non-event from my perspective. What role are you suggesting or advising for that particular asset class in your clients' portfolios?
Well, if you start off, as you say, fixed income, certainly in the developed world, interest rates are hopelessly low, so we're completely avoiding that. If you look at South Africa, the interest rates are higher, but relative to where the expected inflation could be, it's not offering you a nice real return, particularly if you're paying tax. So from that point of view, we're pretty defensive when it comes to fixed interest. It will be concentrated on South Africa, but we will be typically underweight what the all bond duration is. So there'll be more cash and shorter dated bonds in the portfolio. When we look at equities, we prefer international equities over South Africa. South Africa has got a two-tier equity market. It's got the resources that, depending on what you think international growth can do, you could either say it's not value or it presents very good value. We think it's probably quite reasonable value, and there the expected returns are good. But if you look at the consumer and consumer-related sectors, the retailers and the goods producers and those, they seem to be overpriced at this stage. And then also, if you look at South Africa relative to the international markets, both developed and emerging, we think there's better value to be found internationally.
Internationally, specifically emerging markets, I'm quite interested to see first of all, what your clients' attitude is to investing in emerging markets, being an emerging market themselves, and also what's your sort of allocation to emerging markets in your model portfolios?
Well, to give you an idea, we've got more South African or more international equity than South African equity. So from that point of view, I think relative to the typical asset manager in South Africa, we've got a very small weighting towards South African equity. And then within the international equities, about a quarter of that would be in emerging markets.
The role of alternative investments, still a very small industry here if we look at the hedge fund industry and even the private equity players. Alternative investments, do they have a place for in your investor portfolios?
Typically, if you look at the kind of portfolios that we run where people need to draw from their portfolios to fund their own personal pensions, we think there is certainly a role for that lower volatility type investment that can also offer you a reasonable real return over time. But we go for hedge fund funds and combined in a way where, as I said, it's a low volatility, reasonable real return. It won't offer you the same as equities in the bull market, but hopefully over the cycle you'll be fairly compensated in hedge funds.
And last but not least, passive strategies and exchange traded funds. Are those tools that you use? And if not, what's the sort of view on them?
At the moment, we are still sort of using active managers. Active managers have had a very tough time, the last 3-4 years. But that's because if you look at international circumstances have been abnormal. We think as we return to more normal circumstances internationally, active managers should play catch up and do well. But it's something that one would look at over time and always try and do the best for your clients that you possibly can.